Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing world of corporate filings. Today, we're diving into first choice healthcare solutions. Get ready because this one has more twists than a pretzel, and we're going to try to see if we can make sense of all this. Think of a medical company trying to become a national chain of primary care clinics. That's the short story. But there's a longer one. There's been management changes and a shift in strategy. They're trying to grow by both regular primary care and like the anti-aging hormone replacement kind of wellness stuff. Plus, they want to run their own pharmacy. It all sounds a bit ambitious if you ask me. This is a document that contains not one, but two plans for selling stock. One is for selling stock to the public, and one is for reselling existing shares. We will focus on the first part. The company we are looking at today is First Choice Healthcare Solutions, Inc., but they are considering a name change to Leading Primary Care, Inc. They want to build up some innovative primary care and wellness clinics. This means they are shifting away from their old business model. They are pivoting and doing a strategic shift to new locations. Let's talk about the money. For the last quarter ending in September, they lost about $817,000. Now, if we look at the 9 months leading up to September, the net losses are about $3.9 million. They're sitting on an accumulated deficit, like a debt that keeps piling up, of almost $68 million. So let's just say they have some catching up to do. They've got a few different arms to their business, with names like FCID Medical, and they are planning on new subsidiaries such as the Good Clinic Group, Inc. and LiveWell Drugstore, Inc. Now for the drama. Back in February of 2023, 3 of their 4 board members stepped down because the company decided to go in a totally new direction, which is what you want if you're putting a brand on it. The sole remaining board member is the CEO, Lance Friedman. I guess when you want to make big changes, sometimes you just need a fresh start. To go in this new direction, they bought a few companies, including Point Medical Services and the Good Clinic. These acquisitions will let them offer a more complete health service. Think personalized care plans and maybe even your own custom-made meds. Sounds fancy, right? The plan is to use these acquisitions to create a nationwide system of primary care and wellness clinics. They want to offer personalized care that improves the quality of life for their customers. Their providers will have the ability to offer a robust suite of primary care services as well as refer patients to our on-site laboratory diagnostic, internal compounding pharmacy, and quality of life services when medically appropriate. To keep costs down, they plan on using mostly nurse practitioners instead of doctors. Apparently, the studies show that these nurse practitioners can deliver the same quality of care, but at a lower cost. In general, they seem to have the opinion that primary care clinics will offer a suite of services. That is preventative care, treatment of acute conditions, chronic disease management, women's and men's health services, and mental health care. This is how they expect to drive additional revenue, too, since it helps sell prescription medications and health stuff. The aim here is to improve the overall customer experience. This sounds like a solid plan, at least in theory, but they're going up against established competitors in a very competitive market. This strategic shift and investment has its risks. Speaking of risks, they are required to disclose all the risks that an investor might want to consider. They need extra cash, and they need to make sure they get those regulatory approvals. It's a whole new playing field, and there's no guarantee they'll win. Now, it's time to talk about the details of the offering. They are offering 2 million common units, with each unit including 1 share of stock and some warrants, which are basically options to buy more stock. Each series of warrant will be exercisable immediately upon issuance for 1 common share at an exercise price equal to up to 2 times the public offering price of the units, and will expire 5 years from the date of issuance. Each Series B warrant will be exercisable immediately upon issuance for 1 common share at an exercise price equal to 2 times the public offering price of the units, and will expire 5 years from the date of issuance. They're hoping to get $5 a unit. If everything goes according to plan, they will use this money for acquisitions to hire more people and to expand the business. They are trying to get listed on the New York Stock Exchange under the ticker symbol FCHS. Listing is a big deal because once done, the stock generally has more volume and interest. At the same time, some existing shareholders might be selling their shares. It's a double offering and it can affect the stock price, for example, a dump in stock price. That's a risk they mention on page 17. A few shareholders have agreed to sell 550,000 shares once the deal is effective. This could dilute the value of the stock. Now let's dive into the money. The company estimates that combining First Choice, Point Med Livewell, and the Good Clinic would result in total assets of almost $30 million. On the financial side, for the 9 months ended September 30, 2024, the combination of the three companies would result in a net loss from operations of about $1.1 million. There are a bunch of existing stockholders who are expected to sell shares. I don't think most of them are individuals, which would have been the type of situation I'd normally try to analyze. They hold warrants and also shares that they will sell to preserve value in their prior investments. The merger with Point Med Live Well and the Good Clinic involves FCHS stock. The public offering will occur through the NYSE at a minimum $10 million, and these acquisitions are immediately after the deal. There's a ton of information that is uncertain based on them completing their public offering, and if this won't happen, the acquisitions won't close. The company has posted minimal profit and has accumulated losses, and this is a risk. Then there's the risk of failing to grow or, on the opposite hand, having trouble managing rapid expansion. All are typical risks that businesses face. This company may strain its resources and increase demands on our executive management, personnel, and systems, and our operational, administrative, and financial resources may be inadequate. This company has been going for a while, but it's not been listed as a public company. A reverse stock split that increases the stock price is also being considered. These anti-takeover rules may make the sale of the company harder to proceed. Here is a big one. The former chief executive officer, Christian C. Romandetti, SR, was arrested in 2018. He also pleaded guilty to conspiracy to commit fraud. As you can probably guess, it's not really a good look to have a fraud CEO. On the more positive side, this company uses technology to manage its operating units. And this is an advantage over companies that do not use technology, which allows costs to be more easily maintained. Overall, the risk section of this document goes over a lot of stuff. Basically, this is a risky investment because a lot has to go right for this to happen. To execute the company's business development plan, which there can be no assurance we will achieve, the company may need to raise additional funds through public or private equity offerings, debt financing, corporate collaborations, or other means, and potentially reduce operating expenditures. Let's talk about the leadership. Lance Friedman has been CEO since 2020, and he's got a background in corporate finance. Also, Michael Howe is on board as president, bringing experience from other healthcare and consumer companies. There are 100 million shares of common stock authorized. The company has warrants that can be issued as well. They intend to apply to list their common stock on the NYSE and has to be approved for the deal to proceed. Overall, the business has been audited. While it has been a difficult time, the auditors at least believe the reporting is accurate. Dawson James Securities, Inc. is the underwriter for this deal. The underwriters will get 8% of the proceeds and potential warrants to buy additional stock. There is a 45-day option for them to purchase more shares. The law firm Sicenzia Ross Ference Carmel LLP is vouching for the validity of the stock sale. Manat, Phelps & Phillips LLP will act on behalf of the underwriters in this offering. Final thoughts. First Choice Healthcare Solutions has a compelling vision for the future of primary care. They are trying to become a high-technology and high-touch environment. The high-touch environment sounds quite expensive, but the company needs to execute a rapid turnaround and manage both potential growth while keeping costs under control. A strong management team and strategic deployment of capital will be critical to make it through the current challenges they're facing, and this company has great potential, but it comes with very high level of risk. Make sure you consider this if you're thinking about investing. Thanks for watching. If you enjoyed this video, please like, comment, subscribe, and hit the bell for notifications for more Corporate Decoder.